So starting our discussion on Chapter 4, we are going to be talking about income tax withholding, specifically federal income tax in this chapter. You can see our new quote on the, it's pretty funny. Oops. So I'm going to kind of pop through some of these earlier slides just in that we've already had quite a bit of discussion around this. As far as who gets taxed, well, we know that they've got to be in an employee-employer relationship, right? And independent contractors, we don't withhold federal income tax on. It's got to be in a proper employee-employer relationship. And the question then becomes, what do we withhold FIT on? Well, we know the first one we've been working with FICA, right? Obviously, we're going to withhold taxes on wages and salaries, but we're also going to withhold federal income tax on vacation pay, bonuses, commissions, and then there's an introduction of this new term called supplemental wages. Anybody have any idea what a supplemental wage is? Ever heard the term? So it's things like severance pay. Thank you very much for your service. We don't need you anymore. Here's $500 on your way out the door. Supplemental pay is things like retroactive raises. We do that all the time here. For like right now, we haven't finalized our contract that started kicking in our pay on last July 1st. So when the union negotiates the contract, we'll get a retroactive increase that takes us back to July for what we should have been paid since then. The reason I'm going into this, these supplemental payments are taxed differently. So you can't just throw them in with everything else. So just put that in the back of your head. We'll be working with that down the road a little bit more. Okay, tips. We know that we've got to pay tax on tips, and we've practiced that. There's two kinds of tips, right? Reported and allocated. Do you remember which ones you pay taxes on now and which ones you don't deal with until the end of the year? Which ones get included now? Reported tips. And then what happens with the allocated again? It goes on their W-2, and then you've got to put it on your tax return and pay your FICA and your FIT at that point in time, right? Taxable fringe benefits. This is a new topical area in this chapter as well. Taxable fringe benefits are specific benefits that the Internal Revenue Code identifies, or Congress identifies through the IRC, that we have to pay taxes on. And so I'll show you in the next couple slides what sorts of things are in those categories. And you also should make sure to take a pretty strong peek at Figure 4-1, which lists all the types of taxable payments. So I'm not going to spend a ton of time on that because you're going to look at that. Okay, non-cash fringe benefits. What are some things my employer provides me that isn't cash, but that is valuable to me that I have to pay income tax on? Here's some examples, and this is not a comprehensive list. This is just a smattering of items. But tickets to athletic events. Here you go. Here's your season tickets to the Lakers or the Grizz or the whatever, right? My employer gives it to me. The value of those tickets shows up on my W-2, and I pay federal income tax on them. Okay, so they're not like free tickets, I think.
So the employer needs to communicate that to their
Oh, absolutely.
Okay, they're buying it somewhere, so it should be somewhere they can.
Absolutely. Athletic club membership. Now, if I've got like an on-site gym, like at DirecTV, they've got an on-site gym. I'm not going to get charged the value of that. But if my employer pays for me to belong to the Source or the Peak, those are taxable benefits. Okay? Personal use of a corporate car. This is a big one. Did we talk about this with FICA? Yeah, we talked about this before. Okay, how does that work? What do I have to do if my employer gives me a car and I can use it in my off work hours?
Keep that personal.
Yeah. I have to log, don't I, of miles. And then depending upon what kind of car it is, I multiply it by a per mile number. 20 cents a mile, 38 cents a mile, depending upon how what the value of the car is, right? Frequent flyer miles, honestly, the IRS gave up on this. Technically, if you fly for work and then you accrue frequent flyer miles that you then use for personal pleasure, that's technically a taxable event. There's no way to track it, and everybody just gave the collective, we're not doing this. So they just backed off of it. I mean, it's on the books as a taxable event, but it doesn't really cover it. Stock options. What's a stock option, and how is that different from just a flat-out stock grant? Anyone know? If I got a flat-out stock grant, like I work for Google, and they say, well done, great performance this year, your R&D division did a 13% return on investment, I'm going to give you 1,000 shares of stock. How would that show up on my tax return?
At that point, I mean, depending on what happens with that stock.
They give me the stock, flat out, give me the shares of stock.
What's the value of them? And
That's exactly what I have to do. I have to then go and say, oh, what company did I use, Google?
Yeah.
Google was trading at $62.39. So I've got $62,390 of taxable income that year. They just gave me the stock. Sure. Now, a stock option, you guys, is different. Does anybody know what it is? Where's my glasses? So a stock option isn't an actual grant of glasses. An actual grant of stock, it's an option to purchase stock. And it doesn't work, the same. Works a little bit differently. Fine. A stock option gives you the right to purchase a share of stock. And a stock option gives you the right to purchase a share of stock at a set price. So, for example, if I get an option, 100 options, let's say, to purchase Google at 45 bucks. Okay. On the day that I get that, oh, sorry. Do I have anything of value? Oh, come on, Sophie. Can I see anything? No. Looked like it was trying to, there we go. Okay, what's your question? The day I get the 100 options, it's not the actual stock, it's the right to buy Google shares at 45 bucks a share. What's your question, Nate? Yeah, what's Google trading at today? So today, I'm going to give you two examples. In example A, it's trading at 40 bucks. How valuable are these? They're not that very valuable at all because I can go anywhere in the open market and buy them for 40 bucks, right? Why would Google ever do that then? Because this happens all the time. Why would that be valuable to me?
Well, a lot of employers, they usually, it's kind of like from when I'm working, I got one, it's kind of like a 401k, like you match. Some match, certain amount, and then.
Yeah, you're talking about a really specific thing called an ESOP.
Or what about like the brokerage fees are usually a lot lower when you're in the company too.
It is. That's all, those are all sort of, I don't know the details. I want to look at the forest first.
Because you gotta keep that option, the stock may go up and you can buy later on.
Right. If my employer gives me options at 45 bucks and the stock is trading at 40, it's worth nothing to me right now. But they're incenting me and my team and all my colleagues to drive the share prices up to 100 bucks a share. Then guess what? I can buy them at 40 bucks a share, or 45 bucks a share, excuse me. I've got a lot of value, right? So sometimes they will issue them under market. Okay. Now, stick with me here. So on the day they give you the options, you don't have a taxable transaction. because you may or may not exercise them. In other words, take your $40 in your option and go buy a share of stock. That's what exercise means. What if they gave me, on the day that they gave me the 100 options, the stock was trading at $70? Okay, today I could go exercise them and I would have $25 a share in my pocket, wouldn't I? Okay. But my point is they're not taxable until I exercise the options.
Which means buy them.
Which means buy them. Exercise is a fancy word for I take my piece of paper that says I have a right to do this, and then I've got to come up with the money to buy them, and then I go purchase them. Yeah.
And it's
What you were talking about, Preston, is sometimes these are embedded in a retirement program, and those are called employee stock option programs, ESOPs. But those are a little past our scope.
Okay, well, the one I was talking about was like Walmart, and it wasn't a retirement thing, they just matched like 15% on the first $1,500 you bought into their stock.
Yeah, that's an ESOP. Okay, so when this happens, kind of got off track here a little bit. When that happens, that is a non-cash taxable fringe benefit. Okay, and it says when the options exercise, not when I get them, because they may just expire and they're never valuable.
So then are they taxed on the actual market value of them or the amount you paid?
They are taxed on the difference between the exercise price and the fair market value.
Okay, so only on the gain. So if I bought the
I take that back. The first part of it is taxed as or this is getting too complicated. There's two tax rates.
okay, so they're taxed different rates.
Yeah. This is income tax class. So for our purposes in here, you need to know if your employee exercises stock options, you have to withhold federal income tax. Okay, that's what you need to know, because this gets complicated quick. Okay, what is specifically excluded? In other words, I don't have to pay federal income tax on. If I work for an airline and I get to fly for free, qualified employee discount, I don't have to pay the value of those things. If I work at Rock and Rudy's, I get everything at cost. I don't have to pay tax on the qualified employee discount. If my employer gives me tuition waivers, meals and lodging for his or her benefit, don't have to pay tax on it. De minimis fringe benefits here, have a smartphone or an iPad or whatever, and of course you're going to use it for personal too. They're not going to make you track what percentage of your smartphone you use for personal. It's called de minimis, it's too small to track, right? It's immaterial. And then there's a complete list fund.
What about reimbursing employees for insurance, like their health insurance or for their phone?
Not taxable. Health insurance is specifically excludable. They absolutely want employers to do that without tax burden to the employee.
And what if, so like you say, like the other two employees, that, and they want you, they can bring us the bill and we'll pay it. But I don't think, for whatever reason, there's enough to do I don't know how we could get into insurance, but so that's, they would not be taxed, they're paying it.
If you pay somebody, if I bring you my cell phone bill every month, and you're like, you cut me a check for $111 to cover my cell phone bill because I use it mostly on behalf of your company, you're going to cut me a check, but you're not going to run that through payroll.
Mm-hmm.
You're going to cut me a check, and your accountant is going to code that in the books to telephone expense. Yeah. Okay, so what do we do? How do we withhold federal income tax on fringe benefits? Okay, so now let's just go back and let me tie this into this concept I introduced at the beginning called supplemental wages. So supplemental wages are taxed at a flat 25% for feds and 3% for state. And what they're saying here is non-cash fringe benefits can be taxed in one of two ways. Like a supplemental wage, i.e. flat 25.3, or you can say the value of the, whatever, athletic club I'm just gonna add that to my regular paycheck and then go, we don't know how to do it yet, but we're gonna go to our tables and our books and figure out the FIT. So, and you can do that flexible, in a flexible manner. So, for example, if my company pays $2,000 to Missoula Country Club for me to belong, okay? The value of that $2,000 is a non-taxable fringe benefit to me. Am I gonna want that $2,000, the federal income tax taken out on that all on one paycheck? No, because I'm barely gonna get any pay, am I? I wanna do what's called flexible reporting, so I'm gonna break it up and just have them add $500 of value to each of 4 paychecks, or 200 to each of 10, or 100 to each of 20, or whatever, to minimize the impact of the federal income tax on any one paycheck. So what I'm saying is, if, say that my pay, just try this, let's say that my pay, my gross is $48,000 a year. I'm paid monthly, and they also buy me $5,000 season tickets, to the Raiders. I know that's not a right price. Let's say $15,000 season tickets. Okay. And can you read my writing? So I'm paid $48,000 a year. I'm paid monthly, and I have $15,000. They give me 15 season tickets worth $15,000 to the Raiders, and they say we're going to allocate this over four checks, 5 checks. What is a paycheck going to look like? I want you to calculate the actual paycheck, i.e. gross minus FICA minus FIT, for one of the checks where they're putting 1/5 of the season ticket fund. And just use 10% for your FIT. God bless. So I want you to run a check, and then just like we practiced. Yep, 10% FIT for one of the checks where some of the ticket, the non-cash fringe benefit, is actually coming through. So each paycheck, my gross is going to be 4, right? And then each of the season tickets is going over 5 checks and using flexible reporting. So on those 5 checks, I've got to add 3,000 to the actual check of 4,000 to calculate the taxes, don't I?
So we're acting as though it's 7,000 gross, correct?
Right, but how much is the actual gross? 4,000, right? 48,000 divided by 12. So my point is, my gross paycheck's 4,000 every month. But in 5 of those months, the taxes are calculated on a piece of those season tickets. So they're not really free. I mean, it certainly didn't cost me 15 grand, but they cost me some tax money, didn't they? So how is that different from a check without the season tickets? Those checks, you're just going to calculate the tax on the 4 grand, right? You with me? So whatever the numbers are, obviously, the paychecks that they put on the 7 is going to be a smaller net, right? Smaller net paycheck because they're taking out more taxes on those 5 checks.
This might be off topic, tell me if it is, but isn't that double taxation because when the company pays for those season tickets?
They get a write-off for it
Okay,
on their tax return.
I see.
That's a corporate write-off to them.
Okay,
Just like her example of paying the employee's phone bill,
right,
she gets a write-off on her company tax return for telephone bill.
I see. Okay.
Okay, everybody on the same page? You want to ask me anything? Do you want to go home?
I heard she said go home.
Nice try. Okay. Tips, we've seen this before, so I'm not going to beat a dead horse. You have to report your tips, and then the employer does exactly what we just showed in the last example, don't they? You tell me how much tips you made. I add that on to what I'm actually paying you, and then I calculate the taxes. But I don't pay you tips. You've got the tips in your pocket, right? So that's one thing I have to do. The other thing I have to do is I have to make sure that you're making at least minimum wage. Not important in Montana because I'm paying minimum wage, but everywhere else, or most other states, I only have to pay you how much? $2.13 an hour. So I gotta make sure your tips get you up to minimum wage. The last thing is I have to do a calculation to make sure you're reporting at least what? 8% of your,
Or all that.
of your sales. Of your sales, how much did you sell? How much booze, how much food, how much whatever, right?
I never learned about that. Some new restaurants that function out, for whatever reason, maybe not running very well, maybe they're not doing as well.
If you're not getting 8% on a regular basis, there's actually a form you can file to petition that number. It's pretty rare.
I have a friend that works in Wisconsin, and she said that at their restaurant, they can actually write people up for not reporting or not making enough tips on a shift because it's bad service. I thought that was kind of
You're not going to keep an employee that's not
I
getting
know.
8%. I mean, in the day and age where actually average is now around like 18 to 20%, somebody's making 8, they're not a particularly effective server.
Absolutely. So I just thought that was interesting.
Yeah. Okay, so we've been through, oh, go ahead.
That would be me.
Oh, it is not true.
Not everyone is born to be a waiter.
And what about
No.
Starbucks? I used to at Starbucks, there is like, they get paid like a work, like a wage, or do they get?
Actually, Starbucks is a sustainable company and they pay living wages. They
Okay.
calculate living wages by community.
Okay.
So they exceed minimum wage. Okay, so, and again, just to reiterate, you've seen this before, but so when we get these allocated tips, right? I reported 500, I should have reported 700. So the employer allocates me 200. Does the employer have to withhold taxes on that 200? Nope. Okay. Traveling expenses. This is sort of what you were talking about, Shauna, but it's travel rather than telephone. So if I go out on behalf of my employer and I travel and I use my credit card and I come back at the end of the month and I fill out an expense report and I say, can you please reimburse me the $836 I just spent traveling or using my personal phone or whatever the case may be, and they cut me a check, you would think, well, obviously that's not going to be taxable to me, right? Because it's not really income, they're just reimbursing me. But the employer has to have something called an accountable plan in place. And if you just Google it online, accountable plan, Internal Revenue Code, you'll get a one-page template that's pulled right out of the Internal Revenue Code. And you're supposed to have one of those approved and sanctioned in your company in order to reimburse people, and then they don't have to declare it as income. If you don't have an accountable plan in place, you're supposed to put it on their W-2. In reality, and then they write it off on their tax return, on their items deductions. In reality, most people don't know about this, and so it's not complied with terribly often. But if you were audited, you're not going to get audited, a construction company with 2 employees, but I mean, a big company that's got a lot of people that travel, the IRS wants to know that you have an accountable plan, which means when you come back with your expense report and credit card, I need to see receipts. You need to give it to me on a timely basis. You have to have written on each receipt what the business purpose was, right? So there's like some proper record keeping. Okay, what specifically is exempt from FIT? Ministers, advances, if you pay my tuition, if you pay for me to move. There's a benefit in the Internal Revenue Code that helps you with, like in big cities, you can, if you're van pooling or carpooling, I think 3 or more people, you can drive in special lanes. Up to $255 a month if your employer helps you with that kind of thing. You don't have to pay tax on it.
Ministers' wages aren't federally taxed?
Nope. So here's your figure 2. So I'm saying to you, you need to know figure 1 and figure 2. Okay, now stick with me. This can get a little complex. So first off, what does that mean, pre-tax salary reduction? That's like the total multiple.
That's like your retirement, 401k.
A pre-tax salary reduction is take money out of my paycheck and put it somewhere for something we'll talk about. And when you do that before any taxes are paid on it. So if I earn $1, I get to take $1 and put it over here. Okay? Not $1 they take tax and then I put 80 cents over here. Pre-tax is I get to take it straight out and put it in this other account. Okay? For what? Well, for things like cafeteria plans, like flex spending accounts, like 401ks. Okay? Now, let's kind of dig into some of these. Cafeteria plan is basically, we've got one here. They give us, I don't know, I'm just making this up, but they give us like $900 a month, let's say, and then they have this laundry list of all these benefits we can choose. And you can either choose the benefits, or, well, in our example, you lose the $900. You've got to use it on benefits. But in some companies, it's like, do you want $900 or do you want the benefit? Do you want to get dental care, life insurance, and health care, 401k contribution, right? Here we use it or lose it, obviously you're going to use it. Okay, so that's a cafeteria plan. We're not going to spend a ton more time on that in here. What I want to focus on are FSAs, flex spending accounts. These are super valuable instruments because you can take $1 out, put it in an account, and then use dollar for dollar of that pre-tax money to pay for your dependent care, your daycare, or if you're supporting a parent, or elder care. So to pay for dependent care or anything medical or dental related, or eyes or teeth or anything like that. So what exactly does that mean? Let's just do a quick example, because these are really powerful instruments. So that's a separate thing, and maybe that would be a good thing. Okay, so maybe we should do this. So this is flex spending account and health spending account. A flex spending account can be used for two different things. One is dependent care. Like I said, my daycare bill, or I have somebody come in and watch my mom who's my dependent. She's got Alzheimer's. Or for, med, and I'm just going to write et cetera. So medical, dental, optical, any of that. Okay. HSAs are only for medical. FSAs have absolutely no tax, no FIT, no FICA. So you earn $1 and you get that $1 to pay for your daycare bill or your medical bills. God bless. HSAs is pre-tax only for FIT and SIT. In other words, you still have to pay FICA on those amounts. FSAs also have what kind of scares people, is a provision called use it or lose it. And a use it or lose it provision means if I elect, so I'm sitting here looking at 2018, right? And I say, I think that in 2018, I'm going to have $3,600 worth of daycare bills, right? $300 a month. And at the end of the year, I've only had, let's say, $2,000 of daycare bills. That's $1,600 that they've taken out of my check that I haven't used. I lose it. Use it or lose it. So you've got to be really calculated in how much you project you're going to need in the next year. But you have this huge benefit that you pay no tax on any of it. With an HSA, say my medical bills are going to be $2,000 next year, because you can only use HSAs for medical. I'd say my medical bills are going to be $2,000 next year. I only have $500 in medical bills. That other $1,500 just rolls into the next year. And then I put more, it rolls to the next year. And then say in year 3, I have something that takes $6,000 of deductible. I've got it all sitting there.
So there's a lot behind these,
So FSAs have been around forever. HSAs are relatively new. They're a big tool in meeting some of the requirements of Obamacare. They're used, yeah.
So like the thought process behind this is not FSA, it's not taxed, it's not at all, and you get to withhold the amount from the taxable paycheck, and it's non-taxed. But then you lose that. I mean,
that's what I'm saying. You would not. You don't. I used these FSAs when I had daycare bills. I mean, if you work full time, you know what your daycare bill is.
When you got to the
Right. Exactly. Sorry.
When I got to like the end of the year, I would do sort of contracts or something, like a ton of contacts.
Ton of contacts, or
You might hold it, but
Fill out.
all that, absolutely.
They're really-
You save big bucks using an FSA. Big bucks. And HSA has a less dramatic impact because you still have to pay FICA on those dollars. You only get out from underneath income taxes. But there's no use it or lose it risk. But you can't use that for daycare, you can only use it for medical. The second thing about HSAs that you should know is probably not as important to most of you because you're pretty young, but for somebody in our age bracket, as we put money into our HSA and it rolls over from year to year, knock on wood, so far not going to use it, you build up a balance. When you retire, it converts to an IRA. For retirement. Okay, so The numbers around this can get kind of tricky, kind of fast. I do want to take the last 10 minutes and at least get us into the tables to learn how to figure out federal income tax, but we will work some details on these next week. I want you to be able to do your homework for Monday. So let me roll off of this. I'm going to come back to this. Okay, so I'm running payroll for all you guys. You've each given me a W-4, which has told me how many exemptions you have. And now I'm running your paychecks and I'm trying to calculate your FIT. Down here, the W-4 identifies it's called your number of withholding allowances. And you get one for yourself, unless like your parents complain, right? Because they still support you. So everyone gets one for themselves, and you get one for each dependent. So I'm a mom, 2 kids, I'm going to claim 3, obviously. And then there's a whole series of special withholding allowances that are a little beyond our scope. I'm not going to talk too much about that, but on the actual W-4 on the back side, there's a big worksheet you can do. If you've got rentals or you itemize deductions or you're a trust fund person, there's a lot more to it. But in our little simple world, we're going to take one for ourselves and one for each dependent. Okay, on a W-4, you can choose a box that says I'm single, I'm married, pretty self-explanatory, or I'm married, but I want you to withhold at a higher rate. Why in the heck would you want the IRS to withhold more money? And maybe you owe money for other stuff.
Maybe you're partially self-employed.
Maybe you're partially self-employed. Maybe you, that's probably the best example. Self-employed or you have rental income or something. You want your employer to just take more money out of your paycheck. You don't want to mess with the estimates.
So you don't get a bill.
Right, you don't get a bill at the end of the year, exactly. Okay. You can claim exempt. In other words, that says to me, your employer, do not take any income tax from my paycheck. Doesn't everybody want to choose that? No. You can only choose it if you had no income tax last year and you expect none this year. In other words, I'm a student, I have a kid, and I'm making $6,000 a year. Your standard deduction and your exemption are going to eat up all your taxable income. You're not going to have any tax bill. So you just get to claim exempt. Don't even bother taking money out of my paycheck. I shouldn't have any taken out. I'm going to have to file a tax return to get back my $236, right? Okay, good grief. So much here. Okay. What I want to get to, and I'm flying through all this, I'll go back, but I just want to give you a couple examples so you can get your homework done this weekend. Okay. How do you calculate federal income tax? Let's open our books, and it's in the appendix. All the way in the back, I think appendix T. Is there an appendix T?
Yes, before.
T is before A.
So everything's after. It's like the last thing here other than that.
Okay, I don't have them in here, that's us. Okay. Oh, no, here they are, okay. So now, 2 things. On pages T2 and T3, those go together. That's called the percentage method. And if you highlight that on page T3, that's right in the heading, percentage method, right? If you go to page T5 forward, those are called the wage bracket method. And here's the scoop. You're going to always want to use the wage bracket method unless the person's too high income, in which case you go to the percentage of withholding. The wage bracket's easy peasy. And you can see how they're set up on page T5. If you're paid weekly and your W-4 says single, use this table. Right? Next page. If you're paid weekly, your W-4 says married, use this table. And then bi-weekly single and bi-weekly married, and semi-monthly single, semi-monthly married, okay? And you just pick the number up and that's it. Okay, so for example, let's just do one. My Aunt Nani's annual salary is $40,144. She's paid biweekly, and her W-4 shows married with 4. Please calculate or find her FIT withholding. She's paid biweekly, and her annual gross is $40,144. Really?
When we married,
1544.
oh, I'm sorry, that was, I'm sorry.
I was gonna say I shouldn't have showed them that. Did you guys get $60? So I go to page T-8. And I look between 1540 and 1550 under 4 exemptions, or 4 allowances, and our FIT withholding $60. I just pull it right off the tables. Piece of cake. Go ahead.
I did most of it, but how do you want us to print out the Excel part and then do we help the?
No, just do it by hand.
Under?
Just do it by hand.
Oh,
Okay, now what's happening? Let's see about John. John earns $84,400 and he's paid biweekly. Tell me first off, you're going to see an issue right away, and then we're going to walk through an example. And hopefully that'll be enough to jumpstart you.
Probably be married. Well, are they both playing themselves then?
Yeah,
Is that what's going on?
yeah. Or maybe they got special withholding allowances. So what's the issue when you go to the tables? It doesn't go that far. He's too high income. If somebody's too high income for the wage brackets, now we have to go back to pages T2 and T3. And you have, yeah, T2 and T3. You start the calculation by going to page T2 and finding how much each allowance is worth to him. So on that table, if you're paid biweekly, how much do you get to subtract for each allowance? $155.80. How many allowances does he have? Just one. So you take his gross wage for his biweekly minus 1 times $155.80. So write all this out, please. Step 1, if you're using the percentage tables, is to take the gross minus, parentheses, number of allowances times whatever the number is. Then the $3,090.35 is what we're going to take over to page T-3. Which matrix or which table am I using? 2A or 2B? I'm using 2B. That's an algebraic formula. You need to translate it from a word problem to an algebraic statement. So I'm on page T-3 with $3,090.35. And I'm trying to write this in an algebraic formula. And it says, if the amount of wages after subtracting withholding allowances is over $1,042, but not over $3,225, then the amount of tax equals $71.30 plus 15% of the excess over 1,042. Excess of what? What was that number we just calculated? In step one.
2,935 minus 1,042.
Yep. So whenever you've got multiple parentheses, do the math in here and then multiply it by 15% and get me that answer, and then add it to 7130, and that is the tax to withhold. Looks like you've got some math issues somewhere in there. Did anybody else get the 378.55? Okay. So that's the amount of income tax to withhold. Let's try one more in the last couple minutes. And while you're doing it, I'm going to pass around. If you're an accounting major, you need to see me to get your PIN for registration. And right now, here's the times that I still have open. I'll make some more times. I'm going out of town. So, and you start registering on November 2nd. So let me put up another example while you guys fill that in. If you're not an accounting major, get with your individual advisor. Okay, now we've got a gal. She's got an annual salary of $336,000, and she's paid monthly. I can tell you don't even bother with the wage brackets. Her W-4 shows married with 2. What is her FIT withholding?
So on this one, we would have to do the cap for OASTI and then also the additional Medicare.
You would, but we're not doing that. We're just doing that.
I know,
but
but
yeah, she's got a lot going on. If none of those things work for me, we'll set up the one-on-one. Or work for you, we'll set up the one-on-one. So did everybody catch it? You have to multiply the 337.50 times 2 because she had 2 allowances?
That's already finished. Well, it finished the first round. Sounds good, man. Thanks. Okay.
Now, in this example, I think I'm on table 4B. And she's over 20,000, but under 35,158. So write out the full algebraic formula and then solve for it.
And that really
I'm in room 408.
and the percentage. On the amount
Above
Okay.
20,000. So she pays $4,317 plus everything above 20 grand, she's in the 33% marginal tax rate. So she's got $6,700 withholding, but she's also making 20 grand.
Yeah.
So she can scoot by. Okay. So for Monday, take a shot at the homework. We'll go over the homework. We've got a lot more lecture to do. We'll work together on both Monday and Wednesday, and then your quiz is on Friday. And then I'm gone next Monday. You know that, right? Huh? I think you'll be fine. You'll just get it done because we'll do a pretty thorough review, crunch your numbers. We're basically going to be just crunching numbers on Monday and Wednesday to get through this chapter. Have a good weekend. Enjoy homecoming if you're going.
Good question.
Yeah.